Quick question. What if one of the most common pieces of credit advice you've heard was actually costing you money? Not in a dramatic, you're financially ruined way, just in a quiet, annoying, death by a thousand paper cuts kind of way. The kind of thing that doesn't feel like a big deal in the moment, but adds up over the years. Here's the reality. Americans are seeing over $1 trillion in credit card debt. The average credit score is 714, which sounds fine. Good, even. But good and optimized are not the same thing. A lot of people are stuck in that middle zone because of beliefs about credit that sound reasonable and just aren't true. But today we're doing a myth-busting session. 5 credit score myths that sound smart, that a lot of people still believe, and that can quietly cost you real money. I used to believe a couple of them myself, so this isn't a lecture. It's more like us cleaning up some bad advice together. By the end, you'll know what actually moves your score, and it's a much shorter list than most people think. Let's get into it. Okay, real quick. Before the myths, why do we even care about a 3-digit number? Because your credit score is basically a permission slip. It decides whether you get approved for an apartment, what interest rate you pay on a car, whether your credit card company hands you a card with actual perks, or just a participation trophy. A difference of even 50 or 60 points can change your mortgage rate enough to cost you tens of thousands of dollars over the life of the loan. That's not an exaggeration. That's just math. And I promise, this is the last time today I'm going to make you think about math. The problem is credit scores got wrapped in this fog of half-truths that get passed around like family recipes. Somebody's older cousin said something once, it sounded plausible, and now it's gospel. And 20 years later, you're still doing it because that's just how you build credit. Meanwhile, the actual rules haven't changed nearly as much as the rumors have. So let's clear the fog, one myth at a time. Myth number 1, checking your own credit score hurts it. This is probably the most common one, and I get why it sticks around. It feels like it should be true. Why would looking at something change it? Here's the actual distinction most people never get told clearly. There are 2 different kinds of credit checks. A soft inquiry is when you check your own score, and when a company quietly looks at your credit report to pre-approve you for something. These do nothing to your score. You could check it every morning with your coffee, and it wouldn't move the needle. A hard inquiry is different. That's when you actually apply for credit. A card, a car loan, an apartment, and the lender pulls your full report. That one can drop your score a few points, usually temporarily. So the myth isn't completely made up. There is a type of check that matters. It's just not the one people are scared of. A lot of people avoid looking at their own score like it's going to attack them, while freely applying for multiple store cards in one weekend because someone offered them 15% off. The real cost of the myth? People just don't check. They miss errors on the report, which are more common than you'd think, and they don't notice a problem until it's already done more damage. Not checking doesn't protect your score. It just means you find out about the issues later. Number 2, carrying a balance helps your credit score. This one bothers me the most because it's not just wrong, it's expensive wrong. The belief goes, if you pay your card off completely every month, the system doesn't see you using your credit. So you should leave a little balance to show activity. That is false. Credit scoring models do not reward you for owing money. What they care about is credit utilization. How much of your available credit you're using. Lower is better. Under 30% is the common guideline. Under 10% is even better if you can manage it. Paying your card in full every month keeps utilization low and still counts as positive activity. You get the benefit without paying interest. Let's put real numbers on this. Say you leave a $500 balance on a card with a 24% APR for your score. You're paying roughly $10 a month in interest. That's over $100 a year for a strategy that doesn't help you. Over 10 years, that adds up to real money you could have kept. Somewhere along the way, use your credit card got twisted into owe money on your credit card. Those are not the same thing. One builds credit, the other mostly builds interest payments. Myth number 3, closing old or unused cards helps your score. This one comes from a good instinct. You're trying to be responsible, tidy up your wallet, Get rid of a card you don't use. Very relatable. Very Marie Kondo. Unfortunately, also kind of backwards. Two things happen when you close a card, and both can work against you. First, length of credit history. Part of your score is based on how long you've had credit, including the average age of all your accounts. If you close your oldest card, you can actually lower your average account age, which can ding your score. Sometimes not immediately, since closed accounts still count in your history for a while, but eventually that account drops off and takes its age credit with it. Second, and this is a sneakier one, utilization. Same concept for myth number 2. Let's say you have 3 cards with a combined 15,000 in available credit, and you're using 3,000 total. That's 20% utilization. Totally healthy. Now close one card that has a $5,000 limit. Your available credit drops to 10,000, but you're still using the same 3,000. Suddenly, your utilization jumped to 30%. You didn't spend a single extra dollar. Your score can dip just from tidying up. Now, I'm not saying never close a card. If it has an annual fee you hate paying and no benefits worth it, that's a legitimate reason. And it's a decision, not a mistake. But if it's a no-fee card you just don't use much, it might be doing you a quiet favor sitting in a drawer. Sometimes the most productive thing your credit card can do is nothing. Myth number 4, you need to go into debt to build good credit. This one scares people, especially if you're just starting out. The idea that you basically have to owe money to prove that you're trustworthy with money. Kind of a weird system if you think about it. But the good news, it's not actually true. It's just a misunderstanding of how the system rewards activity, not debt. Here's what actually builds credit. Using credit and paying it back on time over and over. That's it. The whole trick. You can build excellent credit using a card for something like a phone bill or a streaming subscription and paying it off in full every single month. You'll never carry a balance, never pay a cent of interest, and your score will climb just fine. Sometimes faster than someone carrying debt, because on-time payment history is the single biggest factor in your score. It's worth more than any other single ingredient. If you're starting from zero, no credit history at all, a couple of beginner-friendly options actually work well here. A secured credit card, where you put down a deposit that becomes your limit, so there's basically no risk to the lender. Or becoming an authorized user on a family member's older, well-managed card, which can let you inherit some of that account's positive history. Neither of those requires you to sit on debt. They just require showing up, on time, consistently. Which, let's be honest, is a very achievable form of main character energy. Myth number 5, your income and job affect your credit score. Quick one, but it trips people up in interviews and job change moments. So worth covering. Your salary, your job title, whether you got a raise or got laid off, none of that's factored into your credit score at all. The credit bureaus don't even know what you make. Your score is built entirely from your borrowing and repayment behavior. On-time payments, utilization, account age, credit mix, and recent inquiries. The stuff we've been covering this whole video. Now, income absolutely affects whether a lender approves you and how much they'll lend you. That's a separate conversation lenders have on top of your score. But the number itself, the actual 3 digits, don't care what's on your pay stub, which honestly is kind of nice. It means someone early in their career with a modest income and good habits can outscore someone earning 6 figures with messy payment history. The score rewards behavior, not paycheck size. Bonus myth. A credit repair company can fix your score fast. Okay, one bonus myth, because this one costs people money in a much more direct way, as in someone literally charging you for it. You've probably seen the ads, pay a monthly fee, and a credit repair company will get negative marks removed from your credit report and boost your score in weeks. Here's the honest version. Anything a paid credit repair company can legally do, you can do yourself for free. Their main tool is disputing inaccurate items on your credit report, which is a real and useful right you have. But it's also something you can do directly with the credit bureaus at no cost, just by writing a letter and using their online dispute tools. If something on your report is accurate, you genuinely miss payments, you genuinely have collections, no company can legally make that disappear early. Anyone promising to erase accurate negative history fast is, at best, overselling, and at worst, running a scam that leaves you out of a monthly fee with nothing to show for it. The legitimate version of fixing your credit is just time, on-time payments, and low utilization, doing their quiet, unglamorous work in the background. Not exciting, also not something you should be paying a stranger $99 a month for. Quick recap. What actually moves your score? Here's the short version of what actually matters. Pay on time, every time. This is the biggest factor. Keep utilization low, ideally under 30%, lower if possible. Let your accounts age. Don't rush to close old cards. Apply for new credit when you actually need it. That's the core of it. The credit score rewards consistency, not debt. The next time you hear one of these credit tips floating around from a relative, a coworker, a guy at a party who definitely also has opinions about crypto, you've now got the receipts to know what's actually true. And honestly, that's most of what building good credit comes down to. Not some secret hack, just not accidentally sabotaging yourself with advice that sounded right 30 years ago and never got updated. If this cleared something up for you, do me a favor and hit subscribe. I'm putting out videos like this regularly, breaking down the stuff about money that nobody actually explains clearly. And if there's a money myth you've always wondered about, drop it in the comments, because there's a good chance it's becoming a video. Thank you for watching. I'll see you on the next one.